I believe in using simple moving averages for enabling a tried and true trend following strategy. On this chart, I'm showing the S&P 500 with the 20-day and the 200-day moving average, of course, a daily chart. The reason that I like these two trend lines the most, or these two moving averages, one, let's talk about simple moving averages. Simple moving averages are just that. They're simple. They're a clean average over the course of the number of bars or candles in that time frame. So if you're looking at a 20 day, that's the average price exactly over 20 days. If you go here to a weekly, that's the average price over 20 weeks. And then, of course, you can extrapolate some equivalencies between moving averages. So if you're looking at a 7-day moving average, for example, then you can extrapolate that down to, like a hourly chart, the same moving average, but with a different candle time frame. I don't even have the number in front of me, but you see what I mean. So you can do all sorts of stuff with this. You have a lot of flexibility, but there's also some standards. And I view it to be important that I am using tools that others in the market are using. So I have this toolbox that I have on TradingView. It's available for free. You're welcome to check it out. And I show moving average types. I default it to simple moving average. You can also do EMAs or ALMA, which is an even faster moving average. It really can be an early trigger sign. That's why I like it. EMA is faster. It weights candles more heavily that are closer to the current price. It's also more complex in calculating. However, in a fast-moving market, it can do a better job sometimes in capturing the dips, whereas it might not reach the SMA, especially looking at the 200-day. I use the 20 and the 200 primarily. I also like weekly moving averages, the 7-day moving average in crypto or the 5-day moving average in traditional markets, and I'll show you an example of that. Go ahead and turn that on. We'll look at the S&P. So we'll change it to a 5-day, and on that one, I kept it as a daily moving average, whereas the others, the 200 here, current time frame, 20 current time frame. The 20 SMA is the same thing as the Bollinger Band midline. That's what the Bollinger Band system uses by default. That's why I think this moving average in particular is looked at a lot, because Bollinger Bands are one of the most popularly used tools in trading. So now I'm gonna dig into a 30-minute chart here. So here you can see this is the 5-day moving average. It's stair-stepped because of these sessions on the day. And then we have the 200 bar moving average on this 30-minute and the 20. And the reason I like the weekly moving average in this case is because it can be similar to VWAP, but it's obviously not volume weighted, but it can be the type of thing that people use as logical bounce points, or an ability to stair step off of. So I like these weekly moving averages. I like to be able to see what the weekly moving average is on a daily basis, if that makes sense, and then I show it on any time frame, so I kind of get an idea for where some potential bounce points are. Let's look at the same thing on Bitcoin. And in a 24-hour market, you would change it to use a 7-day moving average to get a proper view of what a week is. So here we adjust it to a 7-day moving average, and you can see how, not always, but at times it can give you a hint that Bitcoin is going to be responsive at that zone. And, I've not mastered this or anything, but it's something sometimes I like to look on with my chart when I'm in particular trying to analyze these lower time frames. I want to see, hey, what's the price right now relative to what it's been all week? That's all any moving average is really doing for you. That's on a low time frame. All right, that's enough with the 7-day. I want to dig into what I think is most important And to me, that's the 200 day and the 200 week. So here we're looking at the Brave New Coin Liquid Index. So this goes back to the full history of Bitcoin. The green line is the 200 day. The white line is the 200 week. I'm sorry. The green line is the 200 day. The white line is the 20 day. And then we'll show the same thing on a weekly basis. The 20 day is more of a short term helper. A lot of times a move can be confirmed for a quick trend flip by crossing the 20 day. You can see back here, obviously it rocketed up, but the 20 day can be respected for pretty decent periods of time, but you can also get chopped up by it like the whole world did in 2018. But I like to use it as confirmation, sometimes as support, and then sometimes as if it's breached but then recovered quickly, then to me that's a signal of strength that the market wants to keep moving up. You can see that happens pretty frequently where it gets tested or it gets, it's not respected, but then when it flips back, kind of similar to a swing failure pattern where, the down move can't sustain, like in this scenario, and then it's used like a spring almost. That's the 20 day. More important than the 20 day is the 200 day. Look at the bull market. The one time it actually touched it in 2016, July, rocketed off of it, and then it didn't even reach it. Now, if you go look at these, this is an example where the EMA did better than the SMA because this was a historically fast-moving market, so it just never made it to the 200 day. Now, I'll take us to when we're in this downtrend. The 200 day was just a rock solid roof. Like anytime it got close to it, the trend was bearish. People escaped this market. I especially like how strong it is on these two moves where, the trend of the lower high, even a higher high, really stuck with the same as the slope of the 200 day. Things like that. Back here, the rejection off. This one was fascinating where fake China stuff, consolidation, the breakdown was right with that 200. And now we're in this period where we did the opposite, where we're showing strength relative to the 200. We're showing the 200 potentially recovering. I really like the 200 day for my tradable strength of the market. And it's just extremely good. Now, when I consider full market cycles, I often look at the Bitcoin 200 week and other markets as well. And Bitcoin, this is the BLX. It goes back as far as we've got. So we didn't have a 200 week moving average because Bitcoin's such a new asset until April 2014. So therefore, there's only been these, couple market cycles where the 200 week can come into play. But did it come into play? I mean, unbelievably so. It was a grinding support back in 2015, and we double tapped it in 2018 and 2019. Never got to it here. This is where I was prepared to say, like, I'm all in. And if we lost it, I would have been really worried. But it's so valuable. What I want you to look at on the weekly, the 20 week is a very tradable support in trends. And then also when we break it to view a difference maker in the market. The break above the 20 here was our signal for movement. Now, it didn't tell you we're going up to here, but it told you that something's different. Something's different here than it was back here. Failures at times. 2018 was just really tough in general, but you can see this weekly failure. That was a great place to have just really messed me up, and it did. Because I trusted the 20 week, and the 20 week is normally really good. It doesn't mean it's perfect, but from then on out, you can see how the 20 week and the 200 day were pretty well aligned, but the 20 week even tighter on rejecting Bitcoin there. And then we saw the consolidation here, the breakdown, the retest, the move down, just really, really strong in terms of being a quality trend analysis tool. And again, what we saw here is a flip and a perfect retest. And now we're seeing markup. So this is why when I compare this 20 week, the slope of the 20 week movement back into this prior consolidation. I just can't be bearish Bitcoin right here. Just looking at 2 moving averages. That's all I got. It's 2 moving averages. Now you may say, well, this is just some kind of selective bias. How's it work in other markets? The 200 and the 20 both are used in so many markets as valuable tools. We're on the weekly. This is the S&P 500 weekly, and look how much this thing respects the 200, using it as tests for support, using it as bearish retests, similar flips, rejections, significant buying off of the 2011 kind of fake back down before we went on our S&P infinite money printing journey. Didn't even quite get to it here, but obviously seeing strength off of that, very worthwhile. And then the one that I did use it in order to get long back here, just massive support off of that 2018 meltdown and then bounce off. Now, it doesn't tell you how high you're going to go. Like, we could have stopped here and then just bounced along. We could be sitting today, somewhere around $250 or whatever and grinding the support. The S&P didn't do that. It's not telling you where to sell. It's telling you where to buy. It's telling you where to look for supports. You can use mean reversion or a combination of moving averages, like if the S&P broke the 20-week to the downside, as better confirmation of downside. You can see there's more fake outs in a strong market like the S&P to not respect dipping below the 20-week, but you can similarly use the flips back above as signs of strength in the market. So you have to learn your strategies over time, but the reason I like it with the 200 day and week is because it's just such a valuable tool in the tool belt over time. If you look at altcoins, this is Ethereum versus BTC. There's some fake outs for sure on this weekly with the 20 week, but it's still pretty good in terms of helping out. The daily 20 and 200 I find quite valuable with altcoins. It's not as clean. You're working on a BTC relative pair, but it is valuable. It can show you when there's a significant shift in the market. And it's a combination of things. It's not just the fact that it's over it, but it's also the slope of it. Look at we're still downward sloping here. We never really flipped it very well. Still, it's a good fake out. But then we had confirmation of rejection when it lost them. So you can use this as an effective trading strategy. You can combine it with horizontals. You can see this horizontal right here. It broke down the horizontal. It retested the horizontal. Sell the crap out of Ethereum. Sure, go for it. I'm not saying this is the only tool, but I'm saying you can use this as an effective tool. What do you see in Ethereum here now? You see an extremely strong trend. You see the 20 and the 200 flipping. I'm not necessarily saying you buy because it flips, because you're buying up here. But you might use it as a sign to know, hey, I do think dips are for buying because we've seen, a cross in these moving averages that's valuable. A lot of people talk about the 5200. I've talked about the 5200. I like the 5200. I like the 2200 better because it's faster in crypto and these markets move quickly. If I'm going to talk about crosses at all. But this shows me that there's a macro difference in this market that I need to be considering. It tells me to transition my bias from maybe if I'm in a mood of, selling rips while it's in a downtrend, now I'm changing my bias to say, well, maybe I want to be a buyer of dips instead. Not to say it's perfect, but if you go look at other altcoins and stuff, this is where it's a little more pseudoscience, because altcoins are pseudoscience themselves. Like, you look at this in a traditional market and it's versus the dollar, and you think, well, this is obviously depressed. There's no real trend here, but perhaps this is long-term accumulation. Perhaps in commodities markets where they tend to be cyclical, tend to have really quality floors, you can really use this. In altcoin land, people love to say buy low, sell high. rather than going with the trend. If you're going to abide by this strategy, I don't knock it. I've seen it works enough times. You can see similar concepts, and you can combine it with other things. You can see this increasing volume, the crossing, the retesting, the unwillingness to go below that 200-day, the fact that it's just continually supported that. Now, if this breaks down or up, either one's going to be a big signal to me because it's spending so much time trying to decide. So this shows uncertainty to me in this market. But if Raven moves up, I think it could move up a lot from here. If it breaks down, I would really watch out. I don't know that I'd want to try to catch this at the range lows. I might look for new lows if it can't handle this 2200. So in a scenario like this, it both shows you an area of support, but it also gives you this opportunity to say, hey, maybe I can set a tighter stop on this play. So that's an example of what you might do there. And if you look at the 200-day moving average on a whole bunch of coins, let's go to one that has trended pretty strongly, BNB. It was a great signal several times on BNB as well. You didn't have to bother with BNB until it confirmed the trend flip back here. It told you over here that this was not a great move. Price gets far enough from it, you might start to look for mean reversion. And now look, we're seeing another trend flip and then confirmation of the trend. So in this scenario, you might have been wanting to buy 20-day all the way to the 200-day with a stop below the 200-day. And what are you looking for now is, well, you're really looking for continuation. Now, this isn't telling you, again, where to sell. Like, you might use other tools for that. But from a pure trend following perspective, it's giving you some really interesting places to look at. And you may not find them as interesting from a pure like horizontal support and resistance standpoint. You may, but if I go just put a cursor over this 200-day moving average, for example, I don't consider this a super important horizontal, but I bet you if price does move back down here, it will be a place of interest for price. And that's what moving averages do. They give you a dynamic support resistance line, moves over time. What's awesome is when it does align nicely with horizontal supports and resistances, but it doesn't mean it has to. And that's what I really like about it. That's how I like to use it as a part of my strategy. Sometimes I'll say, hey, I want to trade this before it does what I think it's going to do. Other times I say, I'm going to wait for the breakout and I'll buy the retest. Or maybe I won't buy the retest. I'll just get an entry just because it broke. It just depends on what your strategy is. But I can use these combinations of moving averages to really set myself up to find really nice tradable setups and use them in conjunction with other tools and to get an overall picture of the market. I like other trend following tools as well. I've talked about the cloud plenty, the Ichimoku cloud. My podcast partner, Josh Olszewicz, swears by the cloud because he's really great at system trading with the cloud. It has a lot of similarly valuable stuff in it. It can be really, really useful as an assistant to trading. I would say the cloud, it offers you additional stuff. Like, for instance, I think the cloud can give you some pretty good signals for not only when to buy, but when to sell. Can show you some interesting methods for establishing targets. But the barrier to entry to learning the cloud and then the number of people that watching the cloud make it a little tougher of a strategy for me to use, because I think that the barrier to entry is higher. It's a little more confusing. You've got a lot more lines on the chart, if you will. And then just not quite as many people use the cloud as a tool, especially in legacy markets, versus these tried and true moving averages. What I do love is when I can use two trend following strategies, both of which that I find to be very useful, and I can see confluence between them. So if I can see a setup that's a trend following setup where both the cloud and the moving average setups are both telling me the same thing, then that gets me really excited. In terms of time frames, I like the daily and the weekly the most. There are some other ones that are really useful, but you can use moving averages or the cloud on all time frames. But I hope this video represents why, personally, I see tremendous value in the simple moving average trend following system, using those moving averages as touch points, using them as strength of trend, mean reversion tools. There's all sorts of stuff that you can do with them, and they're a very simple indicator to use. That's why I love them. Have a good day.